How has the retreat of traditional bank lending, evidenced by the 12% real terms fall in 2023, shaped the current UK funding landscape for SMEs?
So bank funders have had appetite that's waxed and waned over the years. At the moment, banks seem to be quite aggressive. However, banks typically are a lot slower than IRR-based funders. And as a result, what you will find is you might get a very quick set of terms from someone who is a debt fund, whereas a bank might ultimately get there but be cheaper, but also take longer. These are factors that you need to factor in. If you start your process earlier, you might be able to access cheaper funding. What has happened over the years as the banks have retreated, that's opened the gap for more non-regulated funders to come into the market, which has expanded the capital options. However, it has also made it more difficult for you to be able to access a good side-by-side comparison without getting some form of professional advice.
What is the benefit and potential drawback of relying on government-backed loan schemes for UK businesses?
So the UK government has a number of schemes, some such as the Export Finance Guarantee Scheme, some such as the Growth Guarantee Scheme. These funds have typically enabled businesses to increase their profile with regards to the security that's provided. So in the event that a loan goes badly, the government will then sort of cover the loss. The problem is the government also charges a fee to the funders in order to access these schemes. So what that effectively means is that from the funders' perspective, those are more expensive facilities, so they might charge you more. What that allows individual businesses to do, where perhaps their risk profile might be too high for a traditional funder, they can then access facilities that they otherwise wouldn't be able to access, and the difference is just made up in price. This goes back to that risk, cost, and control triangle effectively, and the government is effectively helping bridge the gap between funders that perhaps would be outside of their comfort zone without some form of additional security.
In the hierarchy of capital sources, what are the first, lowest risk steps a business should take before seeking external funding?
Previously, I've talked about the capital spectrum where you might have, say, property financing all the way through to equity. However, there are cheaper sources of capital available. You can pay people slower and collect in your financing quicker. So good credit control should be the first step for anybody that's looking to raise capital, because actually if you can raise it through your own working capital cycle, it's going to be much cheaper than borrowing it from anybody in the market, even property providers.
What are the key differences in expectations and influence that an owner can anticipate from a private equity investor versus a strategic trade investor?
So in terms of potentially selling your business to trade versus private equity, there are three things that generally owners have to take into account. How much are you getting paid on day one? How much are you getting paid overall? And what is your legacy? Now, traditionally, trade investors may be able to pay you slightly more than private equity because they can look at synergies. Synergies might be another word for cost cutting, such as getting rid of staff and so on and so forth. So in that case, you might feel that your legacy is being impacted and you need to factor that into your decision making. Private equity generally are quite predictable in terms of what they like to look at. So they want to see a good growth profile. So if your business doesn't have a strong growth where they might be able to double or treble their money in 3 to 5 years, then effectively it might not be suitable for private equity. You will also need somebody that is able to lead that private equity journey, whether that is you or somebody in your business. Therefore, it's imperative that you think of your succession planning as to who is going to take that business forward after you retire.